In this video, I want to further develop the concepts of risk and return and develop it towards a tool that will help us understand a little bit better about how we choose assets, or better said, how we should choose assets. So we're going to talk about what's referred to as portfolio theory. Right? We're going to talk about assets and financial markets and how we choose between them based on the risk, return, and the characteristics of the assets. We'll talk about some specific ways that we trade. We're going to talk about something called a short sale. And in the end, we're going to talk about what happens when we combine things together. Right? It really is, it is what happens in a company, right? A company, by definition, is a nexus of projects. It's a combination of securities and assets that represent a business. So we want to talk about how managers choose amongst those things. So the first thing we want to do is talk about the returns of a portfolio. It's a very simple formula that is the weighted average of the returns of the assets within the portfolio. So X sub I here is the weight. It's a proportion of how much money of the investment, how much money is invested in asset I. Now the sum of these weights have to add up to 1.0. So at least for the meantime, let's think about these weights have to be, when you add them up, they add up to 1. So you could put 30% of your money in asset A and 70% of your money in asset B. So here we have two investments, P&G and Apple. We have 300 shares in P&G and 100 in Apple. And then here's the relative prices on this date was $80 and $140. Now let's assume that the stock P&G increases to 87 and Apple decreases to 137. Number one, what rate of return did you earn on each investment? Well, we have to do the calculation. The rate of return essentially is what? It's the ending price divided by the beginning price. So for P&G, it would be 87 divided by 80 minus 1 gives us the rate of return. And we would see here that's 8.75%. And likewise, if you take 137 divided by 40 and then subtract 1, we'd end up with this negative 2.14%. Now, how much is invested? In the beginning, it was 300 shares at $80, so that's $24,000. 100 shares at $140, that's $14,000. So we have a total investment of $38,000, which is 63.2% was in P&G, and 36.8% was invested in Apple. So the rate of return on this investment, based on the beginning values, was 4.73%. But what happened to the weights when the prices changed? When the prices changed, the total portfolio went to 39.8, which means we now have 65% in P&G and 34% in Apple. So the weights changed when the prices changed. So before we get any further, we want to talk a little bit about these weights. What would you say if you were going to borrow some money to buy one of these assets? So let's say in the very beginning, you wanted to borrow $14,000 and you wanted to invest all of that, including the money that you already had, $24,000, into P&G. So how much money would be invested in P&G? It would be $38,000. But how much did you originally start with? You only have 24,000 today. So to represent a borrowing of funds, you need to include negative dollar amounts. That implies borrowing. So negative 14,000 would be the amount invested in B. This would constitute, or what would we talk about, we'll define a little bit later, in what's referred to as a short sale. What if we start combining stocks together? We have 3 stocks here. If you look at the stocks, they all have the exact same rate of return, and they all have the exact same risk. But what happens when we combine them into portfolios? If we put 50% in A and 50% in B, again, since they all get 10%, the return is going to be the same regardless of the combinations. But what we can see is different, is absolutely different, is the risk level. 12.07 is the risk of A and B. Of B and C is 2.79%. So you can see that by not investing in A, but by putting money in B and C only, we could get a much lower level of risk. So when we think about combining risks, right? Combining risks into a stock portfolio is going to reduce risk through what's referred to as diversification. The amount of risk that's eliminated is dependent on the degree of relationship between the assets. We have a statistic that measures that. This statistic is what's called correlation. It's a measurement that's shared by stocks, doesn't depend on its volatility, but in order to figure out what happens to risk, we need to know what the degree to which these assets are going to move together. Assets that move together will not create as much diversification as assets that do not. So we have a very basic formula for correlation. The lowest this number can be is -1, and the highest it can be is +1. So again, we have this statistic that measures correlation. So again, looking back at our stocks here, we can see that the relationship between A and B is 0.62. So when you combine them together, you got some reduction in risk, but not a tremendous amount. But when we combined B, when you combine B and C have a very large negative correlation. So that relationship is going to receive the most as far as the elimination of risk. So again, we can see the lower the number, and quite frankly, even the more negative the number, the more diversification or reduction in risk investors will see based on, again, this correlation or the relationship of the assets. So let's look at some real assets. Here we have Apple, Berkshire Hathaway Class B. This is called Fly. It's it actually is a fishing type of a company. We have Google and we have Coors. If you look at the correlations, they're all fairly positive with the exception of the relationship between Apple and Berkshire. Again, it's negative, but it's very, very close to zero. And you can see there is obviously a positive relationship between most assets. So what if we put 35% of our money in Berkshire, 20% in Fly, 25% in Google, and 20% in Coors? Here are the rates of returns that we got from the statistics. Here are their variances. Of course, variances calculated into standard deviation. And here's the correlations between those assets based on these statistics up above. We then obviously look at returns. So this portfolio is roughly going to turn 2.3%. Now let me kind of go back. This data is monthly data. So this is a 2.3% rate of return per month. The standard deviation is 4.5, and the portfolio's coefficient of variation is 1.9. So again, we can look at assets, and then in the end, we can calculate their statistics. The worksheet that we're using here is what's referred to as the portfolio risk and return relationship. So now let's continue talking about this concept of correlation. It comes from another statistic called covariance. Covariance measures the relationship in how two things seem to act alike. Our formula for covariance is it's the correlation between assets A and B multiplied by the standard deviation of A times the standard deviation of B. So for Apple and Google, from our previous slides, it's 0.486 multiplied by 0.791 multiplied by 9.33. So the covariance is 3.59. Between Berkshire and Coors, it's negative 4.09. Now, other than just understanding that correlation comes from covariance, covariance doesn't really tell us anything other than is it positive or negative, because we really don't know how strong the relationship is. Correlation is the statistic that helps us evaluate the strength of the relationship. So what happens when we combine portfolios? As we see, we're talking about combining two stocks. What happens? So if you look at this graph, there was a study done. I believe this study was done in the mid-70s. But essentially, they looked at portfolios. They started with the New York Stock Exchange, and they found the average risk of a stock in the New York Stock Exchange was very close to 40%. And then they started creating portfolios and then calculating the statistics, the risk, the standard deviation of those portfolios. And what you can see is as the portfolios grew, as the size, the number of stocks in the portfolio grew, the total risk declined. Well, the piece that's going away, if you remember from our last discussion, the piece that's going away is the common risk, the company-specific risk. That's the diversifiable stuff. But there comes a point where adding more stocks does very little, if anything, towards reducing the riskiness of the asset. So again, we need to understand a little bit about what happens when we connect things. If these securities are not perfectly correlated, combining them together will function to ultimately reduce the risk of the portfolio. To calculate the variance of a two-asset portfolio, I think it's just kind of important to take a look at the general formula, if you will, for a stock. So this first part, W sub A times variance of A, this is the risk that asset A brings into this portfolio. It's how much A do you have, the weight, times its total risk. This is the part that comes from B. So when you combine A and B, each one of them brings a relative amount of risk to the portfolio. But because these assets are related, this is correlation. Because there is a correlation, there is this additional impact, if you will. I refer to this as the interaction effect. Putting them together does something. They react with each other. If the correlation were equal to +1, the biggest number it could be, then this part of the formula would be as large as it could be, so that the variance of the total portfolio would be as big as it could be. But if the correlation were 0, then this entire part of the equation now is 0, and obviously the variance of the portfolio goes down. But what if it's negative? What if it was negative 0.5? Then this entire quotient is negative. So now A brings risk, B brings risk, and now we have a subtraction of that risk. That's the diversification piece that shows us that there's less risk in this ultimate portfolio. So we get a very good picture, if you will, of how these securities work together. Again, increase the complexity of this by adding a third or a fourth or a fifth stock. So when we think about efficient portfolios, again, we need to identify those things that are inefficient, right? If an inefficient portfolio basically implies that there is another portfolio that is better in terms of both expected return and or volatility. So how can we identify these? Well, let's think about combinations. We have two stocks, Intel and Coca-Cola. We're going to create portfolios. The very first portfolio, all of the money is invested in cores, and then the other part is Intel, and the other part is invested in Coke. The expected return of that portfolio is 26%, and its volatility is 50%. We then calculate return and volatility based on the weights that are in the portfolio. In the end, we end up with a graph. This graph represents all the combinations on this line of Coca-Cola and Intel. So at each end is 100% investment in each asset, and everywhere between on this line is some long position, that is, you're buying both assets between these 2 points. So here we have 80% in Intel and 20% in Coke. Down here we have 20% in Intel and 80% in Coke. So this is the risk and return relationship of all of these pieces. And what you can see if you kind of think about this is, how can you maximize your return? Given these two assets, these are your only choices. But let's look at this point here. If you put all of your money in Coca-Cola, again, you roughly have about 25% in risk. However, if you go straight up, and again, this is a little bit off, if you put 40% of your money in Intel and 60% in Coke, you would have roughly the same amount of risk, but you would go from roughly 5% to about 14%. So we have a 9% increase in return by putting more of your money in Intel and have the exact same amount of risk. So we want to choose something on this upper part of this curve. That's the curve that represents efficient portfolios. In fact, we would define the red part of this curve is what's defined as being the efficient frontier. That is the set of combinations, the set of portfolios that are all efficient. Said another way, that is the set of the best possible portfolios that you can buy. What we want to talk about next is, now that I know what the best things are I can buy, how do I decide what I want to buy? We'll continue that in the next video.